Charles Combrink. He is from Chrysalis Capital.
Thank you very much, Ray. If you don't mind, I'm going to go directly to the presentation, and then I'll take you through it that way. Right, so just bear with me. All right. Good morning, and thanks everyone for joining me for the discussion on private debt. Ray, thanks for the introduction. I'm going to take you through a discussion on what is private debt, then some background to Chrysalis Capital, and then I'm going to tell you 5 things that you should know about private debt. So, first up, what is private debt? Now, private debt is essentially structured term loans supported by traditional forms of security and proven cash flows. The purpose is usually to finance either growth or acquisition, and loans are privately originated and directly negotiated with the borrower. So that is in contrast to, let's say, unlisted credit, where a large company says, I'm going to issue notes or a bond to the market, and they determine the terms on which they are going to borrow from the market. In private debt, it's a bespoke transaction, and we actually negotiate those terms, and we decide what security, what repayment terms, what covenants. So each loan is structured by the lender, and it's unlisted and it's unrated. Loans are typically held to maturity and are seldom traded. So a little bit about Chrysalis Capital. Ray has alluded to it. We were launched in 2008. We are specialists in private debt. So the team has extensive banking experience. We've lived and breathed lending for the better part of 20 years. We manage about R1 billion in assets. So in the team, we also have legal, tax, and property experience, which are all different angles to the lending game, which are extremely important. Property is important because it lends itself to private debt, because we have a strong secondary market, a good working deeds office system, and because property also generates cash flows. So our investment strategy is to provide growth and acquisition finance to an established client base of high and ultra high net worth experienced business persons. And that is a strategy that is specific to Chrysalis Capital. I'll allude to that more a bit later. Ray already alluded to our performance track record. In 12 years, we've never had a negative monthly return. And our flagship fund return is average CPI plus 7, is actually 6.92% per annum over 12 years. So that's an average annual return for the full 12 years. Right, 5 things you should know about private debt. Number 1, private debt is one of the fastest growing asset classes worldwide. This slide gives you an indication of how it's grown since 2008, at which point there was $238 billion managed across the world in private debt as an asset class. That has now grown to over $1 trillion in the space of 12 years. So private debt is no longer a niche strategy. In fact, over the last 6 years, the amount of asset managers that play in this space has more than doubled. So if you look at this graph, which reflects the fundraising by asset managers, you look at the pink line, you see there's a strong upward movement in 2020 despite COVID. So in 2020, asset managers are expecting across the world to raise $292 billion. And the important part of it is that is a 36% increase on the amount of assets managed in this space in 2019. So the asset class is growing very fast. So now we're going to ask ourselves, where's this growth coming from? The biggest contributing factor was the global financial crisis. There were 3 consequences to the global financial crisis which had a direct bearing on private debt. Number 1, the regulation of banks increased, and banks were told they need to hold more capital for the loans that they have out there, and they also need to manage their assets and liabilities better, which meant that they had to do shorter term loans. Now, as a result, banks shrunk their lending books, and there was this big gap in the market where companies and businesses and private property investors couldn't get finance. So that created the space for non-bank lenders like private debt funds to step in. The second consequence was that post the global financial crisis, central banks across the world reduced interest rates to stimulate their economies, And as a result, investors couldn't get very good yields in their cash. So now, since 2008, there's been this search for yield. So if you take points 1 and 2, there's been demand created by banks kind of stepping out of the lending market. And then there's been the supply of cash from investors looking for yield. And the two met in the middle to basically boost the private debt market. I think the third point that is relevant is that post the global financial crisis, listed markets, as a result of quantitative easing, have become increasingly unpredictable and disconnected from fundamental valuations. And that has driven investors to alternative asset classes like private debt. Now, we are in the midst of another crisis, being COVID. And the question is, will these same factors lead to a further growth in private debt? I believe it will. Banking regulation will only increase. Basel III, which is the accord that regulates banks worldwide, will only be finally implemented in 2022. Point number 2, interest rates should remain low as economies struggle to recover from COVID. And lastly, listed markets, are they unpredictable and more volatile? I'll leave that to you to decide. But the growth in private debt is expected to increase. Number 2 of the points you should know about private debt, the power of compounding returns. So the point I want to make here is that if you are generating consistently positive returns, there will be a compounding effect. Now, in private debt, it is an unlisted space. It's not a volatile space because there's limited price discovery. So if you are doing what you should be doing, there will be consistently positive returns and you will have a compounding effect on your returns. So if you look at our longest running fund, the track record, our year-to-date numbers, especially from 2010, it kind of fluctuates between 10 to 12% per annum, with no negative months, in the period from August 2008 until to now. So if you look at how that translates to a graph versus the all bond index and the all share total return index, you'll see that the Chrysalis fund is a slightly upward sloping line, whereas the all bond index is a little bit more squiggly, and the all share index as well. So that volatility counts, it doesn't enable compounding, whereas it did in the case of Chrysalis. So the growth over a 12-year period was 297% in the case of the Chrysalis fund. In the case of the all bond index, 191%, and in the case of the all share, 159%. A point that I do want to make as well is that private debt fund returns are directly correlated to interest rates because the underlying loans are linked to prime. And as a result, it's also positively correlated to inflation. So if you look at the same fund, and this is the stat that I mentioned in the earlier slides, our performance above CPI over 12 years has averaged 6.92%. If I look at one of our other portfolios, which we manage for a large institution, it has done 8.45% above inflation over a 4-year period. So just a point for institutional investors out there, what we offer is a segregated arrangement where we set up a fund for an institutional investor, and that fund or portfolio co-invests with other institutional investors in underlying opportunities. And the benefit there is that the institutional investor is completely in control of its own capital. It doesn't have to worry about being in a fund where someone else is going to redeem, but at the same time, it has the comfort that it is co-investing with other investors in the same assets. Point 3 about private debt. Private debt fund returns are achieved with zero leverage. That is extremely important. And I want to draw the distinction between banks, because what we are doing is very close or similar in most cases to what the banks are doing. I want to draw a distinction between the bank's capital structure and that of a private debt fund. So your average South African bank has equity of 8.5% and debt of 91.5%. It is a highly leveraged institution. That debt includes depositors' money, because that's also debt, loans from the Reserve Bank, loans from other banks, and maybe bonds or notes issued in the market. In contrast, a private debt fund has zero debt. It is 100% equity. Now, to illustrate how that impacts on returns, let's take an extreme example and say, listen, let's say that there was a 10% credit loss, and you need to compare the impact on the bank versus the impact on a private debt fund. A 10% credit loss, if you do very simplistic calculations, would wipe out the equity of a bank. In the case of a private debt fund, a 10% credit loss, assuming a 12% gross yield, would leave you with a marginally positive return for the year. In other words, 12% gross yield, less some management fees and administration fees, no performance fees, you end up slightly positive. So your capital has been preserved. Point number 4 on private debt. Return is determined upfront. Now, this is different from other strategies where you don't know what your return is going to be. In the case of debt, obviously, when we negotiate these large transactions, your interest rate that you're going to pay and the fees are determined upfront, and they are contracted. There's a variable portion. There's, maybe it's linked to prime, and that is a variable part of it. But other than that, that early negotiation phase is about setting the return, and after that, what we're doing is we are managing risk. That is our primary function post packaging the deal. So the next question is thus, how do we minimize downside risk? I'm going to answer this from a Chrysalis Capital perspective because each asset manager has its own way of managing risk. Our biggest factor, which has helped our consistency of returns and our good returns, is that our philosophy is to do repeat business, number one. So it's not kind of once-off business with random people. It's repeat business with a select client base of experienced, reputable business persons. And those business persons act as a filter for us. They remove, via their experience, high-risk endeavors, and that brings the risk in our portfolios down. They also have strong backing balance sheets because they are successful. They've been doing it for a long time, so they've made money over time. And those balance sheets guarantee our deals. So to illustrate what our book looks like, the balance sheets that support our loans, and this is for transactions that are on our books at the moment, 100% of transactions on our book are backed by balance sheets with a net asset value of greater than 100 million. And 50% of the loans on our book are backed by balance sheets with net asset values of greater than 1 billion rand. The third thing that we do to minimize downside risk is we only finance growth and no distress. So I like to say we only want happy stories. We only want to know that whoever's using our capital is going to make more money with it. And half of the work that we do is to make sure that that is the case. The fourth thing that we do is we focus on cash flow, because any business, property, any asset where there's debt involved needs cash flow. Cash flow dries up, that's when a business gets liquidated or goes out of business. So someone comes to us with a spreadsheet forecasting cash flows. We look at it with a fair degree of cynicism. Our view is that there's been more fiction written in Excel than in Word. So we do a lot of work in stress testing those numbers and making sure that whoever borrows is doing so within their debt capacity. Point number 5 is that we use covenants and financial reporting to measure ongoing risk. So covenant is a contractual term which says your debt to equity can't go above a certain level, your interest cover can't drop below a certain level. If your revenue is dependent on a certain amount of customers, we will say, listen, if your customers drop below a certain level, that's a breach in the contract and we can step up and do something. And those are red flags that we use to measure risk on an ongoing basis. Lastly, the more obvious one is we take saleable assets with a stable value as security. So this slide gives you a quick idea of, across our funds, the level of security we take. Typically, and this is pretty much the range, we 75% secured, senior secured. In this case, at the moment, we're 73% senior secured. And a lot of it is property. We believe in property, we like property, and the team has a lot of property experience. So as you can see, 62% is supported by first mortgage bonds over property. And when we say senior secured, that is traditional forms of security. The security that the banks would also take: cash, listed property, debt, debtors, cash, inventory, that type of stuff. Last point, an investment in private debt is an injection of cash into the real economy. It is summarized, so AMO bring out a report every year. It's called Financing the Economy. It's about private debt as an asset class, and their latest report says the following: private credit has established itself as an essential source of finance for the real economy, financing that enables companies to grow their businesses, which in turn supports job creation and innovation. So 2 points I want to make there. Social impact can be high. It obviously differs whether you use financing SMEs or a property investor, but in both cases, cash is being injected into the economy. And second of all, it's not a zero-sum game. So you often hear about financial markets. If someone's doing a trade, they'll say, if you are making money, someone else is losing. And if you're losing money, someone else is making money. It's a zero-sum game. But it's not the case with private debt necessarily. If we do what we should be doing, it's a win-win. We should be lending money to someone else who's going to make money. And as a result, we both make money together. That is all I have time for today. Thank you very much for your time. If you want to schedule a meeting, please do so via the Alt Marketplace website or send me an email directly. Thank you very much.
Carl, thank you so much. I think that was excellent. I have a few questions. First of all, you say you only want happy stories. Well, in a post-COVID world, I think they are very few and far between. Can you maybe give a bit more detail about what exactly are you looking for in the risks of private debt and what opportunities you pursue and which you walk away from?
Yes, I think that's a good question. So I alluded to the fact that we do growth and acquisition. You know, these are the kind of the happy stories. What we're seeing now is acquisition is a big theme. So COVID has led to a shake up in assets, listed assets specifically. So we're busy now with a large transaction of a consortium that want to buy listed property stocks, but also physical property companies, that type of stuff. So acquisition finance is a theme that we see coming through. And then in terms of growth, what we've seen in the last 12 years is, despite anemic kind of economic environment, there always are growth areas and there always are defensive sectors, and our job is to go and find those sectors. An example would be retirement. So we back one of the biggest retirement brands in South Africa, massive demand for it, and the jockeys that we're backing have a massive balance sheet. Another example would be security. Security is a very defensive sector. We've also backed management to buy into one of the largest security companies in South Africa. So it's a question of finding those sectors. Anything where there's consumer facing, it's higher risk. Anything where it's corporate facing, where your counterparty is depending on corporates for its revenue, is lower risk because they will survive through a tough economic environment.
You spend a lot of time talking about risk and limiting risk. What do you think is the risk profile of private debt compared to other asset classes? Can you maybe just comment on that?
Yeah, very good question as well. So I think obviously you need to compare apples with apples. It's a difficult one because you have lower liquidity for private debt. That is one of the biggest features of private debt. But in terms of stability of returns, if you can stomach the liquidity issues, the fact that private debt funds are unleveraged, if you look at that illustration that I gave earlier, makes private debt funds much more able to withstand shocks. So I think, at the same time, if you want to compare it to listed assets, there are a whole bunch of factors like quantitative easing that aren't affecting private debt. So it's difficult. You're not comparing apples with apples, but if you look at, I can only take our track record and the consistency of returns, and that'll give you an indication compared to, if you look at that graph compared to the all share, what was achieved and how volatile the returns were.
Then, since inception, you've achieved a return of 12.04% per annum, which I think is excellent. But we've seen a significant drop in interest rates over the past few years, especially this year. How does that impact your yields?
Yes, so our yields have dropped, our monthly returns have dropped, and it will also drop with interest rates coming down. And that is you know, maybe it's not good in a falling interest rate environment, but when interest rates go up, our returns will go up. So we're quite happy to have that correlation, because it's inversely correlated to other listed debt instruments. And I suppose if you take that further, the correlation is to inflation as well, and that's most important to us, so that we want to achieve an inflation plus return, and that is what we focus on, and making sure that we give that to our investors.
And just lastly, what are the minimum investments for potential investors?
Okay, so our flagship fund, which is available, sorry, I'll call it our flagship, it's the longest running fund, but that's available for individuals and foundations. You go via the Hollard platform. So the Hollard platform allows you to go in, you're not taxed on your yield if you go via the Hollard platform. That's one positive. The other positive is that we can take smaller amounts via Hollard. So probably 100,000 or 200,000 is possible. The only thing that we ask is we want investors to understand that there is lower liquidity in the strategy. So it's not a place where you go and park your cash and enjoy a yield for a couple of months and then take it out again. The idea is that you identify a portion of your portfolio where private debt will play a role and leave it there for a longer period.
Carl, thank you so much for your time today. That was Carl Combrink. He is the founder and the fund manager at Chrysalis Capital.
Thank you very much, Ray.